Sajjid Chinoy is joining us right now, India economist at JPMorgan. Sajjid, good morning. It's a pleasure to have you with us here. Thanks very much, Prashant, this side. I want to start with something slightly global, which has a bearing on India rather than, looking local and then going global. The thing that I want to start talking about is the fall in commodity prices that we've seen. Actually the continued fall.
Yeah.
What do you think this is on account of, Sajjid? Because I think the view differs. Some say the dollar index has appreciated 8% since June. It has, and that is primarily responsible. The other view is, the dominating factor is slowing growth around the world. Latest data all points to that, except US. Everything else is slowing down.
Yeah.
What's your sense?
Yeah. Right. As always, Prashant, I think the truth lies in between. I think there are two important phenomena that are driving this, both of which you alluded to. I think the first is a rotation in global demand away from the strong commodity importers towards US growth. China is a classic case in point. You've seen China slowing quite sharply. You've seen in August, for example, Chinese data was quite horrendous. And yet you've not seen an inclination by Chinese policymakers to necessarily reflate the economy in conventional terms. There is no fiscal space. Like India, China has heavily front-loaded fiscal spending in the first half of the year, so fiscal policy will be tight. And you've seen the PBOC essentially signal that they only want to pursue unconventional, limited tactical monetary easing. You saw that in the measures of the last couple of weeks. So the sense that China is on a structural slowing, along with the fact that generally commodity importers around the world growth has slowed, is clearly one important driver. But you can't separate that from the other driver, which is that there has been dollar strength across the board, which is going to have some impact on commodities. And that reflects another divergence between G4 central banks, that the ECB will be inclined to ease more, the Bank of Japan at the margin may be inclined to ease more, but the Fed, and reinforced by the latest non-farm payroll numbers, is getting closer and closer to an exit of accommodative policy, which will mean the dollar strengthening against other emerging markets. So I think it's really a combination of both these phenomena, a rotation in global demand and a divergence in the way G4 central banks are conducting monetary policy.
What does it mean for India, Sajjid? Falling commodity prices are good for India. We import a lot of it. But on the other hand, if global growth is actually weakening,
exactly,
exports will get hit.
That's right. So I think it's always it's an intertemporal kind of trade-off. In the near term, this is clearly a very positive terms of trade shock for a commodity importer like India, vis-a-vis commodity exporters like Russia, Brazil, South Africa. And the most direct impact, for example, will be not only on inflation, but on the current account deficit. Our forecast for the current account deficit in FY15, which ends next March, could be as low as $27 billion. It's 1.5% of GDP. And that's because, assuming oil's at $100. If you assume the India oil basket's at 95, then the current account could be even lower. So clearly it has an income effect, it'll have a current account impact, it'll have an impact on lower inflation, all very positive for India in the near term. But I think there are two offsets here. The one, as you pointed out, is if this is merely a reflection of China slowing, if this is a reflection of other emerging markets getting hit, to which a growing fraction of our exports are now directed towards, that's going to mean that the support that India has had from exports, frankly, exports have been the only driver of growth in the first 8 or 9 months of 2014, will disappear. The other concern to keep in mind is this could be risk negative, in the sense that if China's growth slows more than expected, if global growth doesn't pick up, risk appetite gets hurt, and that has an impact on portfolio flows into and out from India.
How does one assess, Sajjid, whether global growth-linked assets, and I think India gets counted as one of them for large macro funds. So global growth-linked assets have already fallen too much, vis-a-vis the downturn as far as global growth goes. Is there something that you do at JPMorgan which tells you that? And within these global growth-linked assets, and India gets counted amongst them as well, I think India has relatively remained pretty insulated. It's fallen much lesser against a variety of other equity markets or commodities, etc., etc.?
Right. No, I think that's true. I just one quick caveat to the previous answer. Let's not forget that amidst a global growth slowdown, there will be islands of strength. One important island is the U.S. The Fed will only exit accommodative monetary policy if U.S. growth tracking 3% as we forecasted to. And remember, the bulk of our service exports go to the U.S. and the Euro economy. So there will be some support for our exports. It's not a case that there is a universal global slowdown. It won't necessarily affect U.S. growth. But to your larger point, I think one kind of slight worry and opportunity is that India, I think, is still strongly overweight. If you talk to most investors around the world, whether they're equity investors or fixed income investors, the sense is that for all the reasons we just discussed, India has become a darling among emerging markets. Everybody else is struggling: Brazil, Turkey, South Africa, Russia, and we've got multiple things going in our favor. So a lot of people are overweight India. That's a good thing. That's propped up the currency, that's propped up markets in India. But the worry is if things were to turn on a dime and the US, for example, were to exit faster or global risk gets hurt more significantly, then India could also face disproportionately large outflows given how overweight most Indian assets are. And I think that's something that policymakers need to be aware of, and that's something clearly that the central bank is aware of because it's been repeatedly warning of these dislocational impacts of Fed tightening.
Morning, Sajjid. This is Anindya from the Delhi studio. When one looks at morning, what my parents used to do when I was young is that they put all their money in a savings account or sometimes in fixed deposits because they were very happy when interest rates went up. And now, since all of us live in that economy where we go to work because we owe, right? Because we owe, to work we go. Now we want lower interest rates. That should be true for every fund as well, right? So when you were talking about the current account deficit, so when interest rates start going up in the US and the spread reduces, what happens to the kind of flows we've had into debt?
Well, that's exactly the worry. So the worry is that a lot of debt flows around the world have been driven purely by that interest rate differential. And India is no exception. Now, I would argue some of the steps the central bank has taken in terms of disallowing access of FIIs into T-bills, in terms of forcing them to buy government bonds with a residual maturity of three years or more, has increased the quality of flows at the margin over the last 6 months. But the fact is, if US rates go up in a hurry, and there are some forecasts that the US policy rate by the end of 2016 could be anywhere between 2.5% to 3%, that interest rate differential is going to reduce dramatically. And I think at that point, emerging markets have to make a call. Would they like to see their currencies depreciate? Or in some EM countries that are very linked to the US, would they also raise interest rates to maintain that differential? But that's precisely the point, I think, that premature monetary easing in India is not good for inflation concerns alone. It won't be prudent at a time when the center economy, the US, is raising rates. And to your first point about your parents saving in fixed income assets, it's because for a long time India actually had positive real rates of interest. And the difference in the last 5 years post-Lehman has been real rates of interest in India have been consistently negative, and households have rationally made a choice to flee financial assets and move to physical assets, move to real estate, move to gold. That process is to reverse itself. So I think for a variety of reasons, it's important that real interest rates in India increase and stay positive and don't go back into negative territory.
I'm just trying to draw a parallel from what happened last year. And I always watch the dollar very closely because not for any economic or financial reason, but because to time my holidays. And last year around August, September, the dollar started strengthening and India suddenly weakened and we saw massive outflows, right? Suddenly the current account deficit looked very, very weak. Overnight, all the reserves went away. This time, about 25% of FII flows are in debt. So we have a double problem. One is flows go out, and secondly, interest payments continue. Unlike what happens in equity.
So I would say that there are very important differences between what happened last May when the problem really began and some worrying similarities, but largely more important differences, and now. I think the first thing is the point I made earlier, the current account deficit. If you look at the first half of 2013, the current account deficit was running at 5% of GDP, unsustainably high levels. So India had to attract a lot of capital flows simply to stay in the same place, to finance that deficit. Today it's running at just above 1% of GDP. So the quantum of funds we need every quarter is $6-7 billion. Last year it was 18, 19, 20 billion dollars. Number one. Number two, you've seen the RBI, I think very astutely, significantly increase their base of reserves, intervene much more aggressively on both sides, and therefore rupee expectations today are far more anchored than they were in May, June, July, August. So I think these are very important differences. I would argue that if every emerging market is under pressure, the rupee will not escape that force, but the rupee will depreciate much more gradually. There'll be much less panic, is my guess, than last year, given the change in the underlying fundamentals of the BOP, of the Reserve Bank, and their intervention strategy.
About 3-4 years ago, my nephew, I look young, but my nephew works for one of the top mining companies in the world. He's old enough to do that. And 3-4 years ago, he had come to India. He'd been sent as part of a team to India to work out what kind of demand for ore can come from India. And he came and wrote, along with the rest of the team, a pretty gloomy report saying that there's not going to be much, or there's no demand here. And he sent it back to his boss in Singapore, who said, "Are you crazy? You can't write a report like this. If we do that, they're going to shut down our office in Singapore if there's no demand in this site." So obviously they kind of fudged it a little bit, cut corners a little bit, and gave a slightly glowing report back to the main office, perhaps leading to a little bit of irrational exuberance across the board when it comes to mining, when it comes to commodities. I mean, he's one person, but perhaps across the world that happened to a certain extent.
Yeah, I mean, as it relates to India, as you know, there is no doubting the fact that medium-term potential and demand in India, given our demography, given our savings rate, is very strong. On the mining issue in particular, I think you've seen a lot of sort of implementation bottlenecks. I think, and I think that's where there's a real opportunity here, I think, for the new government to make a big difference. I think
talking about the global space altogether. I was talking about global mining, steel. There seems to be massive overcapacity right now.
Yeah.
Again, the same story. My nephew told me no one cares about India back home. There's only one market, and that's China. We don't care about anything else in reality. So when China slows down, that overcapacity suddenly shows up.
No, I think I completely agree, and that's the point we were really making. So I think there are two issues here. One is that in the near term, commodities will be influenced disproportionately by Chinese growth dynamics. We've heard umpteen stories about a bridge to nowhere, and there is a lot of overcapacity in China. And I think to the extent that policymakers want to substitute the quantum of growth for the quality of growth, means we expect Chinese growth this year. The official target is 7.5%, could be lower, could be 7.1, 7.2. Our forecast is potential growth over the next 5-6 years could come down to the sixes. If that's the case, in the near term, that overcapacity issue is going to be real and will sustain, and for commodity importers like India, provide some relief on the macroeconomy.
So, and as commodities slow down, it is going to be help you bring down inflation, obviously, without having to raise interest rates. I mean, inflation comes off on its own. Another thing that I wanted to know, when US interest rates go up, right? It's slightly more difficult to actually get speculative money into the commodities trade, right?
Right, exactly. And I think that's why you've got this negative correlation between the dollar index and commodities. And the earlier discussion we were having, that the slowdown in commodities has its genesis in two drivers. One is dollar strength, which relates to the fact that the Fed will likely exit sooner than the ECB and the Bank of Japan. And the second is a more real economy issue, which is the fact that Chinese growth has slowed. You've had very weak data in August, and there perhaps isn't as much policy space to reflate the Chinese economy this year as there has been in the past. I think it's the combination of both those factors that have depressed commodities temporarily.
Sajjid, I just want to pick up from where we left off earlier. You said that if there are more risks visible if rate tightening in the US happens faster because of the fact that most people are overweight in their portfolios in India now, we could see a larger sell-off in financial markets, and policymakers need to be aware. You said RBI is quite well aware of it. What about some of the local factors? I was talking to a senior banker, Sajjid, and he said that you know, this project monitoring group which puts out large numbers in terms of project clearances, etc. He said actually the PMG will clear projects, but then it has to go back to the project has to go back to the individual ministry for clearance. That is not happening, and B, work on the ground is not exactly you know, starting up at least at the pace at which we see figures get thrown around. So the global risks aside, what about what's happening locally here in India on the ground? Do you think that pickup is visible?
Yeah, on the ground. So two things. I think one is I don't see any evidence that the pickup is visible. I think what you've seen is some pickup in industrial production mid-year, and that momentum has been lost quite a lot. You've had two very disappointing IP numbers, June and July. The September PMI was very weak, and it comes back to the earlier point that the only driver of growth at this point in India seems to be exports. There was some pickup in consumer durables, but that in a way, the latest data kind of confirm may have been a one-off front-loading of production, sales and demand, because the excise duty cuts were to expire in June and were pushed out till December, and it doesn't seem from the data that it was an organic increase in consumer durables. So that's one point. The other two quick points I'll make is as we get towards the end of the fiscal year, there will be a fiscal drag. You know, government spending will be tight as it typically is in the last 4 or 5 months, and the effect of the bad monsoon, the fact that the Kharif crop was 7% below last year, will begin to show up in the fourth quarter. So I think we have to brace ourselves for the fact that economic activity in India is going to get weaker before it gets stronger. Our forecast for the third quarter, July to September, is growth in the low 5s. October to December could be even lower depending on how bad the monsoon effect is. So let's not expect that there's going to be a big sharp recovery in GDP growth just because we have a new government. Now that said, I've just come off a very long road trip in the US, in the UK, in Singapore, and most investors in India are okay with that. They've heard a lot of stories that there have been significant governance reforms in Delhi, that the bureaucracy is working harder, faster, smarter, in a more coordinated manner. They understand that reforms are going to be incremental, both because there's a technical constraint. Many of these have to be between the center and the states, whether it's land, whether it's the GST, whether it's labor, and because the government's chosen as a strategic choice to move incrementally because it believes if you do so, the reforms will be more durable and will actually happen. So I think I don't want to misstate. I think global investors are so far still very sanguine on India. They're very comfortable with what the RBI is doing, where the rupee is trading, with the fact that inflation is coming off, the fact that commodities help India. So I think global investors will not be in a hurry to exit. That said, I think 6 months from now, 9 months from now, they'll want to see some evidence of things actually happening. And I think that's where your question becomes relevant, that it'll be important in the next 2 or 3 quarters to demonstrate that there's some progress on GST, that some of these projects have got debottlenecked, that capital goods production is picked up. But I think for the next quarter or two, we're okay, because I think most people understand that the process of reform is, slow, is incremental, and involves a lot of hard work.
You spoke about July to September and then October to December as well. So around 5% could slip below 5, who knows. But by when do you, according to your estimates, by when do you think growth will actually start a process of moving higher? It'll start picking up.
Yeah. Our own forecast suggests that really it's going to be another 3 or 4 quarters before what the government's doing in terms of environmental clearances, land clearances, coal production picks up. So it's not until the second half of next calendar year. I mean, the April to June number next year, 2015, will be strong, but that is for a one-off. That's because government spending every April to June is strong after being very weak Jan to March. So discount the fiscal headwinds and tailwinds in the first half of next year. My sense is it's the second half of next calendar year that one can realistically expect to see some impact on the capital goods sector from what the government is doing. And I think that's going to be the yardstick that a lot of investors abroad apply. That if by next year, in the second half, we haven't seen any pickup, I think then there will be questions asked of, why things aren't moving on the ground.
So you're saying July to September onwards, the process of growth revival, we'll see actual GDP numbers starting to tick up on a sustainable basis, right? That's essentially what you're saying. July, September, October, December, and then on.
That's right.
This is 2015.
But remember, that will be a modest pickup. I think 2015. Yeah, I think this has to be a modest pickup for all the reasons we've already discussed. The one, I don't believe there's going to be much space for monetary easing. So the cost of capital may not be the biggest driver. I think what you'll see is these implementation bottlenecks that we've spoken about for the last year, that as they begin to get declogged, as the plumbing gets fixed, that impact will show up on industrial growth, on the capex cycle in the second half of next calendar year in the best case scenario. So let's not expect too much before then.
Okay, so one more question. So growth and then inflation and rates, Sajjid. Do you think the RBI will now only cut when it sees the 6% print on inflation CPI and sort of the CPI staying around 6%? So is that what we have got?
Exactly.
All of us should reconcile with that?
Absolutely. I think we have to live with the fact that the RBI wants to get to at least 6% CPI inflation on a durable basis. What that means is, what the central bank has to internalize is, if I cut interest rates and if I ease monetary policy, and once I take into account the aggregate demand and aggregate supply impact of that monetary easing, and despite the pickup in demand and supply, if I can still hit my 6% target and importantly stay at 6%, then I have reason to cut. That's the way all inflation targeting central banks behave. And I think the RBI will be no different. And I think all credit that they've hit this point again and again and again. So it's now become a part of our consciousness that we should not expect rate cuts if any 1 month's inflation number is low or the next 2 months look good. We have to see 6% till the eye can see, and that's when the central bank will have the opportunity to ease monetary policy. And given that criteria, notwithstanding lower inflation risk from commodities, notwithstanding the pickup in the monsoon, I still don't see any scope for monetary easing in 2015.
Nothing in 2015, so maybe 2016. So actually, it's only 2016 when growth really starts to pick up and inflation maybe starts to drop, and actually interest rates start to maybe ease a little bit, right? So you got all of us have got a long wait, and investors have got a long wait ahead of them. But what you said is that your road trip to US, etc., suggests investors know that, and they're willing to wait that long, right, Sajjid? That's what you're saying.
Absolutely. I think investors realize there are two very big regime shifts happening in India, in Bombay and Delhi. The one in Delhi will take longer. They understand that the government started by trying to fix the plumbing, that it's working in small increments, but wants to make sure durable reform happens, whether on the labor market, on land, on coal, on GST. There are encouraging signs that an amended GST bill, one that's more acceptable to the states, is now being prepared and will be brought to the winter session of Parliament. So investors realize these things take time. Okay. They also understand that in Bombay, there is a very important change on the inflation targeting front that will take time to manifest itself. So I think they're willing to be patient if they see the right inputs, which are currently underway.
No, I think you answered my question, but I'll just still reinforce that, and correct me if I'm wrong. You're saying that it's not just the speed and the efficiency of the bureaucracy and the government functioning, etc. It's the things that are being announced and the things which are being done, which investors, according to you, are quite happy with as well. They're not disappointed, right? I mean, some of the flagship programs like Jan Dhan, what's been done so far? Swachh Bharat. I mean, these are things which investors, portfolio investors, are quite, happy with. Some things like land acquisition, GST, those are things which will come up sometime in the future. Nothing has happened there.
No, and nothing is, let's be clear, nothing has happened on those fronts, but I think they're willing to buy the promise from the new government that these are important policy priorities. They will look at the fact that 3 states have begun to reform labor laws, albeit incrementally. The finance minister has spoken about amending the Land Acquisition Act. There is a GST bill that's been promised to be introduced. So I think they're willing to go by the fact that this government is serious on these issues. Of course, this will be tested as time goes on. Are these milestones being hit? What is the next budget throw up? What does the Expenditure Management Commission come back with? So there clearly will be tests. But so far, I think the governance reforms that you see in Delhi in terms of the bureaucracy seems to be enough for foreign investors to say we're on a good start.
Sajjid, it's a pleasure. Thanks very much for your time. Great speaking with you, as always. And come back soon again. Thank you.